Hi, good morning, everyone. Welcome to the Grow Inspire. This is a show that we have to break down some smart money moves for the golden years, which is something that myself, Atilio Calderon, and my host today will be talking about to bring tax savings to those on the 60s or above. Uh, and for that, we introduce Bonnie Yam. Uh, could you talk a little bit about your experiences on over 60s tax strategies?
That's a very high demand topic. A lot of people wants to know how to manage the money in a very tax efficient way when they hit 60, which is like, I work very hard for my whole life. How much can I save for my taxes? How do I manage my money in order to pay what I deserve? Not too much. I certainly want to keep more money in my own pocket. So let me tell you a little bit about my background. I enjoy assisting people with the financial wellness. I own a tax consulting business. I've been in it for 16, 17 years. I also assisted with Medicaid planning, business exit planning, and now I also assist with taxes. I've given a lot of seminars, including education through SUNY WCC. I'm the adjunct professor there. I'm very happy to be able to share some of my learning today in today's podcast.
Very interesting, and it's also important because as we reach the golden age, it is important for us to learn how to manage our income and reduce the taxes so that we can stretch that fixed income as much as possible. So going into that topic, there is a lot of talking about special credits, deductions available to seniors. Can you elaborate a little bit on that?
All right, thank you. Yeah, that's a great question. Okay, for seniors, okay, when you file taxes, you have to understand that if you're 65 and above, you get more deductions. So a lot of people take standard deductions. So instead of doing the other type where you list all those special deductions, standard deductions is that you don't have to keep receipts. So this is the amount that you're eligible for. Okay, so if you're 65 and above, and if you file single, then there's additional 1,950 that you can deduct. And for married file joint, that's another 1,550. So times two if both of you are over 65 and above. So what is the total now? Okay, so if I'm single or married file separately, so if I add on that 1,950, before it's 14,600, now it's 16,550. So nice, right? And
That's a
and if
big
I
difference.
yeah, and if I file married file jointly, now I'm talking about both of you are 65 and above. So before the deduction, standard deduction is 29,200. So if you add another 1,550 for two, then you get 32,300. 32. Wow. That's a nice amount. Like when you start getting money out from Social Security, a lot of people is about 20 something thousand. So if you get 30 something, okay, all of a sudden like you might not have to pay a lot of taxes. Even if you have to pay, it will be significantly lower.
Right,
Yeah.
right.
And then since we're talking about taking money out from your retirement account or Social Security withdrawal, so maybe we should talk about Social Security benefits taxation. Okay. So if your income, I'm talking about single, one person, if it's under 25,000 or married, filed jointly, 32,000, your Social Security income won't be taxed. Isn't that great?
That is exciting because 32,000 on a married filing joint list, it's just about the average of most of retired people receiving fixed income, you know.
So that
It,
part wouldn't
and it's nice to hear that what we're gonna receive, we won't have to pay tax.
all in your pocket. That's
Yes,
nice,
it's
right? Yeah.
really nice.
Okay.
And
So, okay. I don't know if people know about that. There's another, I just learned it myself recently. I didn't know that this is this program. So, a lot of people own real estate. Okay. They're living in the house that they bought many years ago that they saved up now. Okay. Okay. Maybe they're not paying a lot of mortgage, but you still have to pay real estate tax. So if you are senior, okay, there are a few programs that's available by the government to help you, okay? So let's talk about tax relief program, meaning you own the property. The Senior Citizens Exemption Program that gives you relief up to 50%. That's nice, right? And then
Wow.
there's Enhanced Star School Relief Program. And then Senior Citizen Homeowners Exemption, also called SCHE. So, at least try fill out your application and see what you're eligible for. Because these are also ways for you to help reduce your property taxes. And let's say if you're renting, then this rent relief program for senior citizens. So there's a senior citizen rent increase exemption, SCRIE, and emergency rental assistance program, ERAP. So there are programs out there that can help you reduce your property tax or provide rental relief for seniors.
This is amazing. You know what's even more amazing? A lot of people, a lot of retired people don't know about these credits.
I
And
know.
they're struggling trying to pay their taxes without not knowing that they could get a relief, a big
Yep.
relief.
Yep. It's like one is about paying less taxes. One is like getting assistance from the government to lower your taxes. So
Right.
that's,
Right.
a great thing to know. And while we're at it, okay, let's talk about credits. Now, credits are a little different from deductions. Credit, if you don't, one is to lower your taxable income. That's deductions. Credit means like if I owe taxes, it can help me lower the taxes owed. Okay. And some taxes
Mhm.
are refundable, some non-refundable. So let's talk about a very popular tax credit called Earned Income Tax Credit or EITC. Now, this program is only available for people between 25 and 64. Okay, if you don't have any kids, you don't have any qualifying individuals under your tax return. Okay, so your income has to be under 18,591 for single or 25,511 for married filed jointly. And you get a EITC credit, earned income tax credit up to $632. You say that's not too much. Now, but if you have kids, okay, that really change the picture around. So if you have kids up to three or more, a lot of people they do, okay? I mean, I'm 60 something, whatever, I still have I started late, whatever, okay? The credits can go up to 7,830.
That's a big difference.
That's, I mean, that I'm basically, let's say I don't make a lot of money, my deductions, whatever 20 something thousand can deduct all away all my income. Now this 7,830 would be free money, additional money that I get from my government. But of course, I need to file my taxes, otherwise I won't get
Exactly.
that,
Yeah. You need to
right?
file your taxes and
Exactly.
you gotta
Yeah.
make sure you qualify.
And I would file it immediately because the sooner I file, the sooner I get the money.
Right. Right. And it takes about 3 to 4 weeks maximum.
I would do it as soon as possible. It all
Yeah.
depends on IRS. So it's going to be a couple of weeks. Yep.
Yeah. Okay. Now, elderly people has a big problem, and that is health,
That makes
and is
sense.
a big burden for that group. Can
Exactly.
you comment on some available programs,
Yeah, yeah,
programs
yeah.
that they can take advantage of?
Okay, so there is always the state insurance, health insurance program, the New York State Health Marketplace. Okay, so you can buy healthcare insurance on the marketplace, and depending on where your income is, like if it's between, we call the federal poverty level, 138% to 400% of the federal poverty level. I will tell you later, what is that amount. Then you get deductions, whatever the premium can be lowered. Okay. You might not have to pay any or like, 50% low. All depends on how much you make. Now for the federal poverty level for individual, it's 16,060. For a family of two, it's 20,440. So if it's between 138% to 400%, what would that be? So for individual would be 20,162 to 64,240, which is a lot higher, right? So even if you're making like close to 65,000, you might still be able to get some premium reduction. And for family of two, that amount is 28,207 to 81,760. So you should really check it out. There's a calculator. You go online, figure it out, and how much tax rebates you can get from the premium that you pay to the marketplace. Now, for the really low income people, you qualify, then you can try for Medicaid. And that's for age 65 or above, unless you're disabled. But the income and asset limit is really pretty low. So you can make more than 1,563 per month, and assets has to be under 16,800. Now, there are a lot of people who have more money qualify for Medicaid. What happened? How did they do it? Well, they actually probably need to give away the income, give away the assets, and now there's a 5-year look back period. So if you want to qualify for Medicaid, you have to plan it 5 years in advance. And I would recommend talking to a Medicare, elder care lawyer to assist you with that type of planning. By how do you give away your assets, put it in a trust, do a lot of estate planning. But that's definitely another option. And something that a lot of people don't know about is that besides Medicaid, okay, Medicaid has much lower, the income and asset limit is very low, but there's also Medicare savings program with slightly higher asset and income limits, or EPIC, which is the elderly pharmaceutical insurance coverage, to help you cover for prescription drugs. And we know, like, when you turn 60, a lot of people take at least 2 or 3, chronic type of like assistance with their health. So that can be a lot of money. So even if you don't qualify for Medicaid, think about maybe I can qualify for Medicare savings program or the EPIC program to help pay for prescription drugs. Now, for the EPIC program, the prescription drugs, the income limit is only 75,000 for a single and 100,000 for a couple. That's much, much, much higher, right? Okay. So just like explore your options, I would say, because there are some programs out that can help you lower your medical expenses.
That's really nice that we have all those opportunities. They're complicated, so we need to look for
It's
help when
complicated.
trying to get some of that. Yeah, definitely need help, and that's why we have you and other people who worked in this field. Uh, but there is also for those who have made some investments, like in 401ks and IRAs, and there is an age where we're forced to make withdrawals.
Yes,
What
totally.
can you tell us about those, what they call RMDs?
Yeah, that's called RMD is required minimum distribution. So, government wants you to pay taxes, maybe sometime, okay? You've been deferring for a long, long time, okay? So a lot of the pre-tax arrangement for the 401k, you lower your income and you grow tax defer for many, many years. Now, when you hit a certain age, you say, I think you should start taking some of the money out and pay some taxes back to me, right? Okay. So the government has that view is that it used to be the age is 70 and a half, and then it all depends on your longevity table, whatever, and then divide by, if you have another 20 years, let's say you divide by 20, and then every year you take an X amount out and pay taxes on what you take out. And the penalty used to be 50%, but with Secure Act 2.0, it dropped to 25%. Now, then, they actually think people also living longer, so why should you be taking it out at 70 and a half? So people who are born in January 1960 or later, the new RMD age would be not 70 and a half, but 75. So, a couple more years that you can push down. Now, since we're talking about this topic, I want to talk about if you're going to take money out anyway, think about, hey, manage your taxes, minimize your tax payment. What about like instead of just taking it out, how about I convert into Roth and continue to save and continue to see the money grow? So use it as a way to do Roth conversion. Now, so like since my income is much lower because I'm not working anymore, so use as an opportunity. Like I don't want to pay more than 15 or 25% tax, whatever at that level. So $75,000, I should not take more than that. So use that as a conversion strategy. So that's what I normally tell people to do.
So, and raw is after tax.
Yes, after tax money.
Okay.
Yeah, after tax, so you pay taxes and you invest. The thing is like Roth, the growth. Let's say after I convert, I pay the taxes. The amount that gets into my Roth account is 50,000. And in a couple more years, I'm very lucky. From 50, it grows to 100,000. That additional $50,000 gains, I don't pay any taxes.
Oh, that is
So
excellent.
yeah, so
Excellent.
since I
Yeah.
have to change the pre-tax to after tax, okay, I pay the tax, but then let me do it in such a way that I pay the minimal amount of tax because my tax rate is much lower. And then I continue to grow and save, using that after tax account. So that's another way to help you maximize your earnings and your future growth of the money.
Yeah, that's amazing. That there is another thing that recommend a lot for people, and retired people think that is something that they cannot do anymore because of the fixed income. However, I heard that there are some uh, ways to charity, to give charity,
Charitable gifting,
donate,
right? Yes. Uh-huh.
and that is actually beneficial for
Oh
some
yeah,
of
yeah, yeah, yeah.
those ages.
Now those are like maybe for people who can afford to give out some extra money to help other people. So that's a great way. What I So charitable gifting, you can deduct up to 60% of your AGI uh, when you donate to a 501c, a charity. And then if you donate more than 60%, the additional donation can be carried forward for 5 years. So that's a way to lower your tax, also help the charity that you enjoy helping. And then if you are 73 and above, and let's say I've accumulated a lot of money on my IRA, and when you take money out from your IRA, you need to pay what? Taxes, right? Your pre-tax.
Yes.
Okay, so you can take that money instead of like, okay, withdrawing the money, you can take the 105,000 and give it to a charity. And then that will qualify as if you're taking money out from your RMD, required minimum distribution. So this is another way to, do good and do well and do good by donating your charity since you're going to donate anyway. So take a taxable pre-tax account that you're going to pay taxes on and donate that instead of like an after-tax account and use that to satisfy your RMD. Another one is very, very popular is we know how expensive it is to go to send a kid to college. Even into a state school, it's expensive. So the 529 college savings program is another way to help your grandchildren get college education. Now, this is like kind of like works like a Roth account. You put the savings into this 529 account, it grow tax deferred, and then when you take it out, nothing is taxed so long as it's applied to the education of the kids. And you can gift up to $18,000 per person, okay, in a year. Normally, when you give money to somebody, you have to the person who gifting it has to pay the tax. The donor has to pay the tax. Now, okay, the federal limit for 224 is that you can give 18,000 per person without triggering any gift tax. So for 529, you can actually do something called super funding. So you can do 5 years of gifting in one time. So 18,000 times five. And then sometimes like you can do, well, I mean, if husband and wife, besides time five, you can times two, you and your wife. So 18,000 becomes like,
That would
18
be
times, yeah, it's a huge
36.
$180,000
That's
for
a lot of
for a
money.
couple. And then that's a lot of money. And I think there's like some new law changes, like if you can't use up all the money, some of it can go to the kids' IRA. It works
Wow,
like a
that's
Roth.
amazing.
Yes, yes, it's
That's
amazing, isn't
amazing.
it,
Yeah.
right? So there's a lot of learning. We can go on and on forever, but I think this is like, some really great sharing.
Yeah, the advice here is look for help and try to plan better for the golden ages, and let the money grow without having to pay as much tax.
That's right. Yeah,
Okay, that's great. Thank you, Bonnie. This is all for today's episode. I hope you find this conversation insightful and packed of value for your future. You enjoy it, be sure to subscribe so that you don't miss any other episodes that we may come or we have done already. and enjoy the benefits. Thank you so much. Until next time.
Thank you very much.
Bye.
Thank you. Thank you to you.